Hi, everybody. Welcome to our DAT IQ Weekly Market Update. This is our update for March 11, episode 331. I'm Dean Croak, market analyst here at DAT, along with co-host Chad Kennedy, joining us from our DAT office in India, and special guest today, Kevin Zweier from Argon. Welcome, gentlemen.
Yeah, thanks, Dean.
Hello. Good morning.
Yeah, good to have you. Kevin, it's been a while.
It has. Good to see you.
Yeah. Chad, how's things in Bangalore today?
It's good. And believe it or not, it's a little warmer than Florida. So, it's been good. It's been very nice, very hospitable.
Right.
Yeah.
Good. All right. Kevin, some of the folks that watch the show will know you from your days with Chainalytics and NTT Data, but tell us a little bit about what you're doing with Argon now and what your new role is.
Sure. Actually, the role is pretty similar, just moving to a different organization. So Argon & Co. Is a supply chain consulting boutique, trying to service that chief operations officer and chief supply chain officer all the way from planning on through to transportation, which is where my background and role is. So I'm leading our transportation practice here as we're expanding in the US. Argon has traditionally been bigger in Europe, and now with a bunch of the folks that we brought on, we're looking to expand and do a lot of the same type of supply chain consulting services we've done in the past, but do them here in the US. So excited to be here.
Good. All right, we'll bring you back a little bit later. I'll whip through the market update as quick as we can, then we'll bring you back for an in-depth discussion on the contract freight market after Chad does his forecast section. So some of the key trends we're watching, spot rates for dry van and reefer are pretty flat week over week, not a lot of change there. Flatbed capacity, though, continues to tighten as we head into nursery, large trees, building, construction, planting season. So again, following seasonal patterns, spot rates in flatbed are a little bit higher year over year. So there's a bit of strength in that market on the spot side. The ongoing tariffs between Canada and Mexico are clearly causing some distortion in the market. Dry van rates from US to Canada are up 33% since the election. Canada to the US in the opposite direction, up 21% since the election. Reefer rates, USA to Canada, are up 32% since the election. And flatbed from Canada to the US is the highest in 10 years, excluding the 2022 pandemic-driven spike. So a lot of tightness in flatbed capacity, especially related to the automotive industry and some of those highly integrated supply chains between Canada and the US. The tariff is impacting the spot market, mostly in Canada, largely because on the southern border, it's a lot of warehouse to warehouse, and then contract freight outbound from the trade-free zone on the southern border, very different to the cross-border market in Canada. Some of the other data points, the ISM PMI was out last week, not encouraging, shows some of the negative consequences of the tariff policies. New orders did a U-turn in February, down to 55.81 in January. They were then down again to 48.6 in February. Not good news on new orders. LMI came in pretty strong with their January reading comparatively to sort of where it's been in history, driven a lot by the expansion of inventory levels. Transport capacity, a sub-index of the LMI, expanded to 57.8. Imports came in. I just looked at the data this morning from IHS Market Peers. Imports for February down 10% month over month. Again, no surprise there. Still up 9% year over year. The February TEU import volume was, it's typically the lowest month on the annual shipping calendar following Chinese New Year or Lunar New Year celebrations and factory shutdowns in Asia. Last month, though, they were 37% higher than the pre-pandemic February average back to 2015. So certainly seeing a lot more volume, but it is starting to wind down. This week's market update, the long form version of our show today, will be out this evening, dat.com/market update. We're looking at small carrier operating margins, the Omaha refrigerated beef market, and some of the worrying results from the latest ISM PMI. So let's start off our market update with load posts in the dry van market. Volumes were down about 5% last week, still about 15% higher than last year. For week 10, last week's load to truck ratio was 5.05, mostly unchanged in dry van. And in flatbed, it ended the week at 7.26, again, almost identical to where it was this time last year, mainly unchanged also last week in week 10. Flatbed, though, load post volumes are up for the 7th week following last week's 2% gain. As I just mentioned, we're heading into all of those seasons that involve a lot of flatbed freight. Volumes are about 24% higher than last year. And load to truck ratio ended the week at 39.51. Having a look at some of the spot rates, a little bit more detail today on some of the spot markets we're seeing cross-border wise, but nationally dry van rates stabilised last week. They were flat week over week at $1.66 per mile. That's the 7-day rolling average, excluding fuel. So flat week over week. Load volumes, loads move volume are about 3% lower. The rolling average is about 8 cents a mile higher than last year in dry van, and sitting about 6 cents a mile higher than where it was in 2019. Having a look at some of our Midwest region, what we call bellwether states, a term that REH at the Journal of Commerce has coined. That region has the highest correlation to the national average. In the Midwest, volumes dropped 5% week over week. Spot rates remain flat, paying carriers an average of $1.90. On the southern border, rates were up 3 cents a mile to $1.74 on a 12% higher volume. On the northern border, capacity continues to tighten despite volumes dropping 9% week over week last week for outbound loads to the US. Line haul rates from Canada to the US up 4% week over week. In comparison, USA to Canada in the opposite direction, up 2% week over week. One of the high volume lanes we watch is Toronto to Chicago in dry van. Volumes were down 20% last week, while capacity remained extremely tight. Rates are up 30 cents a mile from Toronto to Chicago, or 18%, averaging just under $2 a mile. That's the highest dry van rates on that lane have been since 2018. In the refrigerated market, even though the volume of loads decreased 4% last week, line haul rates remained flat at $1.91. They're about 2 cents a mile higher than where they were last year, and about 4 cents a mile higher than the long-term week 10 average, excluding the pandemic years. Produce volumes should boost that market as we head into produce season. Volumes were up 19% last week. The average reefer carriers were paid in the produce market was about $3.25, 4% lower than last year. And lastly, in flatbed, despite volumes flattening out last week after rising about 7% in the last month, the national average flatbed rate increased another 3 cents a mile last week to just over $2.07. Compared to last year's 7-day rolling average, that's about 10 cents a mile or 5% higher. Comparing to some of the other bigger years in flatbed, it's about 12 cents a mile lower than 2018, which was a very strong flatbed year, and about 7 cents a mile higher than 2019, which of course was the freight recessionary period following 2018. Quick look at our forecasts. These are our long-term forecasts, well, long-term relatively speaking, out 35 days. Ratecast is forecasting what line haul rates will be for trips over 550 miles, excluding fuel. The blue is the historical rolling 7-day average. Green is what Ratecast is expecting, and it's bounded by a higher case, lower case scenario. Orange or yellow is the uppercase scenario, and red is the lower case. In the flatbed market, it's expecting rates to be down about 11 cents a mile to April 12, ending that period at about $1.55 per mile. That's identical to where rates were this time last year on the 12th of April. So again, and it's also identical to where they were in 2019. If you're looking for a reference point to where rates are relative to some of our poorer years from a demand perspective, almost identical to 2019. Again, pretty seasonally on track with what we'd expect through mid-April. For Ratecast in the refrigerated market, out to April 12, it's expecting rates to drop to about $1.75 before we see produce season start to show some lift in the market. Compared to where rates were last year, April 12 last year, rates were $1.83. That was 8 cents a mile higher than where Ratecast thinks rates will be this year in April, and also where they were in 2018. So Ratecast is looking for a lower year, comparatively speaking, to some of the prior years we benchmark against. And in flatbed, though, quite the opposite. Out to April 12, it's expecting another 4 cents a mile lift to $2.12. This time last year, rates in flatbed, excluding fuel, were $1.98. So Ratecast is thinking that rates by the time we get to the middle of April will be 14 cents a mile lower than, also higher than where they were last year. So a lot of strength in this market as we head into some of those busier seasons in flatbed. But then again, of course, you can see the rates starting to flatten out once we get into mid-April, which again is seasonally what we typically see. Flatbed normally peaks sometime in April, May, and then flat lines for 4 or 5 weeks, and then starts to cool off in the third and fourth quarters. All right, let's have a look at what's happening in the contract market. Over to Chad to take us through that.
Yep. Thanks, Dean. So I'll cover everything from a shipper perspective. So these are all based off of shipper buy rates, shippers buying from brokers and carriers, whereas everything Dean just spoke about was brokers buying from carriers, mostly in the spot market. The first graph here for dry van in yellow is our spot premium ratio, goes back to 2016. And you can see that boom and bust cycle of the market. This measures the premium for spot rates compared to contract rates. And you can see that last data point coming in at negative 10.7. Quite low. I looked back, and that's as low as it was. Last low point, that low was September of 2024. So about 6 or 7 months it's been that low. So that post-holiday spike is behind us, and just this softening season spot markets compared to contract rates. The new rate differential here in the middle, this is a signal of some more longer-term positive news for carriers and brokers. We're seeing increases in the percentage difference between new contract rates and those rates that they replaced. So this answers the question, what are shippers getting yielding from new bids that they're rolling out and starting to execute? The bulk of this freight will start executing this month and next month. That's the largest percentage of new contract rates that we see come in from bids, that large RFPs that started about 4 to 6 months ago. It's quite a long process for larger shippers. And then the contract rate index, still quite flat. You can see a little bit of a bump through Q4 of last year, but still quite flat. No significant movement there. But as we see that new rate differential continue to return positive results, it'll eventually start to push that contract rate index up. So the percentage mix in these three categories: spot, somewhere around 15% of the data; new rate differential, somewhere around 15-20% of the data; and the remainder there in contract rates that are recurring week after week. So let's go on to reefer. Very similar trends. A little bit of a spike there in the new rate differential, which is, again, more positive news for long-term contract rates, starting to see some rate increases for shippers. And then finally, the rate per mile. You can see flatbed down there on the bottom. This data, a little bit different cohort than what Dean's reporting. We're not seeing the big spike in spot rates here. Again, this is all shipper buy rate. Could be a little bit of a different commodity mix too here. This is heavily in the retailer space, and also some construction mixed in there too. But you can see that difference between spot and contract rates throughout history, going back to 2016. So that's a wrap on contract rates. Back to you, Dean.
All right, let's bring Kevin back in. Kevin, against the backdrop of the president talking about not ruling out a recession in the broader macro economy, shippers talking about a wait-and-see type attitude, a lot of the confusion around tariffs, even anecdotally, shippers talking about paralysis in the market as they wait and see what policy looks like for the rest of the year. What are the trends you're seeing in the full truckload bid space as we sort of come out of late last year's bid season?
Yeah, it's been an expectation of the market getting tighter, but that expectation hasn't maybe come through as fully as everyone expected. So what I mean by that is there was a lot more discussion coming into this bid season around taking some risk off the table. Maybe doing some pre-awards and, incumbent negotiations, whatever you want to call it, as a way to, lock in some capacity and take some risk off the table. And that discussion really hadn't been part of the conversation for a number of months, years, going back, as you see in the data.
Years.
So,
yeah.
So that there was the expectation from shippers that this was going to be a quote tougher bid season than what they saw for the last 12, 18, going on 24 months. I think the expectation has somewhat met that, but not completely. Meaning, I don't think it has been as challenging for some shippers as they expected it to be. Not that it has been without its challenges for sure, but I think the expectations maybe got a little bit ahead of where the reality is, and I think a bunch of that has been caused by the uncertainty that we're seeing in the market, this stagnation maybe, where we were going to see, I think everyone thought we were going to see a little bit more pickup, and now there's a wait and see approach because we're not sure what's going to happen geopolitically, regulation, economy wise. So this kind of wait and see approach, I think, is pushing things out a little bit. But I don't think anyone was really expecting the first part of this year to be the go period anyway. I know you all have mentioned it, and I concur, that it was far more likely the later part of the year was going to be the tougher time. And certainly we haven't seen anything to dissuade us from that at this point. So, have results been less beneficial to shippers than they were in the past years? Well, yeah, of course, right? We're a number of the events we've been involved in have either been a little bit of savings, a little bit of cost increase, staying flat, but we haven't seen shippers taking massive double-digit increases by any stretch. And a lot of times they've been able to mitigate whatever increases have come through with some changes in their strategy, in terms of carrier assignment, number of carriers, types of carriers, etc. So it's mostly been something that the shippers can deal with, and not have to go dramatic and upset their networks and do anything crazy, at least so far.
Yeah, it's interesting. I think back to Q4 of 2023, we were in a position where we thought 2024 would be the year that the market really turned. And so bringing shippers back around to Q4 2024, we talked a lot about that in our conversations, and we thought 2025 will be the year. I'm still confident it will turn. It is starting to turn, but it sure is slow. But it's an interesting position for a shipper procurement manager to be in setting expectations internally with their management and how they deal with their suppliers. So go ahead, Kevin.
We've talked about the fact that you got to make sure you have enough friends in your network where you as a shipper are important enough to a broad enough base of carriers for when capacity the capacity crunches a bit and tightens up. Right. And so that they were going to be there. And so, we have seen some expansion of the size of the carrier base, not just that's invited to an event, but that's actually awarded of saying, okay, let's not put all our eggs in too small of a basket here. And so kind of branching that out a little bit. We think some of my shippers should be doing that a little bit more than they have been, because it became a little too easy to consolidate your carrier base when rates were falling, right?
Right.
And there's the risk that you go too far the other way. And so, but we have seen that I'll say gentle expansion of how many providers are going to be in your network, and how much volume you're giving them, right, to make sure that they're staying fed and staying engaged in your network.
Right. Is that capacity that they're adding into their network, is it coming mostly from assets, mostly from brokers, or a balanced mix between the two?
It's definitely more from assets at this point. And I think that's because we're still early enough in the cycle where you can do that, right?
Yeah.
As capacity gets more constrained, that's when you see everyone's brokerage usage go up. And that's what a lot of shippers have spent the last 2 years trying to whittle back down from, the previous crunch, right? Is to get the non-asset portion a little bit under control. So right now it's still been a focus on trying to lock in and get those asset-based providers, well established and engaged in the network for when that time comes that you need more capacity than than you're getting right now.
Right. Kevin, how do you think about? I mean, how do shippers think about that? Because the inevitable capacity crunch is going to come, and of course, the more shippers play the transactional spot market, the quicker we hasten that cycle. So, are they doing what we heard at DATCon, where shippers were looking to lock in that capacity on the higher volume lanes and make more strategic spot buys on the lower volume lanes? Is that something they do to, try and minimize their exposure on the spot market for when it turns?
Yeah, the short answer is yes. I think there is also the play of, okay, where am I from a bid standpoint? Where am I going to focus my energy, right? And so obviously the high volume lanes is where a lot of that focus is, but that's where we've also seen, and I know this was talked about at DATCon as well. We've also seen the strategy around getting plugged into API brokers, and having that be still a part of the proverbial routing guide, especially on the lower volume lanes. And so haven't seen that change dramatically, the percentage of brokerage that's being used. Have seen it change the number of different brokers that a shipper is engaged with. And when I say percentage of brokers using, I mean, that's still, or spot, let me say it more precisely. Spot is still a higher percentage now than if we went back and looked, 5-6 years ago, right? I mean, and I know DAT and Chad have shown that, numerous times in presentations and whatnot, that it never came back down to the same levels pre-pandemic. It's obviously lower than than when we were in the in the crunch then, but has come down, and that goes to, I think, everyone understanding that you have to have, one, your finger on the market, your finger on the pulse of the market, and then two, the fact that there are just going to be lanes, loads, etc., that are more appropriate to be covered by the spot market than they are, under contract. And shippers are more, I think, more accepting of that now than they were pre-pandemic. So
I remember 2018, all the earnings calls in Q4 or Q3 going into Q4. Transportation costs were through the roof in 2018. People were losing their jobs. Big companies were missing their earnings because of, in quotes, transportation costs were up. I wonder, compared to, say, then, we've learned a lot about how to, procure freight or capacity since then. Do shippers generally have more data and transparency at their disposal now to make more informed decisions compared to, say, that freight cycle from 2018 into 19?
They sure as heck better. I think that the short answer is yes. I mean, there's certainly a lot more data available. There's a lot more transparency on the market. I mean, this market's never not going to be opaque, given the number of shippers and number of carriers that are in it. So I mean, there's only so much transparency we'll really ever get, but certainly, it's become easier to access all of that type of information, and especially through DAT, right? So so there's better information. How well is it being used and utilized and brought into the decision-making process? I think there's still quite a variety of capability that we see there across across the shipper community, and just general sophistication on being able to weave that into the decision-making process. But, I think I know Chad and you have beat on this drum. I beat on this drum around, diversifying your portfolio, not just from a carrier standpoint, but how you go after your network, and looking at your lanes differently based upon characteristics and volumes and cycles and geographies and and whatnot. So I do absolutely think that shippers have taken that message to heart, and are doing a more robust job of looking at the network differently. And I'm not saying that they weren't doing that before, but they have more tools to help them look at those different pieces of the network and really let them target their strategies.
This is going to be a challenging year for carriers. I think we're already seeing some carriers struggle with lane imbalance as their shippers source supplies from different markets to, sometimes to avoid tariffs. So especially cross-border volume in the automotive industry. So I wonder, is it too early to tell how shippers are going to react to that, where, the sourcing of supplies becomes a really big issue for them this year?
It feels a little early to see impacts on on that. I mean, I think obviously it depends on the type of shipper and where stuff's coming from, but the pull forward of ocean freight has caused some imbalances because of just the amount of volume flowing in from the coast on that, but it hasn't been, I'll say, dramatic enough to upset the apple cart at this point. But certainly what happens with tariffs with Mexico and Canada, and how that's going to impact cross-border freight, and and I think that's probably more of the concern right now. I'm not saying that it's an easy thing, but we know how to deal with influx of more volume coming in from the coast, right? We've been through that situation before. There's some playbooks around that.
Right.
There hasn't been a playbook for a while to deal with the disruption that we might see in relation to cross-border and and freight moving to Canada or Mexico, and how that's going to impact supply chains, because that's been a point of stability for a number of years. So I don't think your premise is wrong, Dean, that we are gonna see some impacts there, but certainly haven't seen anyone making any any real decisions to change during this bid cycle, and during bids that are out there now, because it's again in that wait and see kind of situation.
Yeah. Hopefully the last 5 years with COVID, and to a much lesser degree, the port strike threats and all that somewhat materializing, shippers have become more agile to deal with this kind of thing and respond to it in an agile way. But Kevin, I'm wondering if you were to give a shipper, first question, a shipper, and then second question, a carrier broker, a number one low-hanging fruit tip of what to do for a shipper in an RFP to have a positive result, and then also for a carrier or a broker, how do they position themselves in an RFP to be as competitive as possible?
Well, I'm going to have a little bit of a cop-out, because I think my answer might apply to both, and it's really transparency. When a shipper tries to game the RFP and hold back information that they think is going to be damaging to the negotiation or to how the carriers view that business, it only hurts them then in the long run, right? So I think you have to be honest with your partners on what are going to be the challenges, what's my network look like, where are my problems, right? Because I think if you try and hide that, you try and hedge your bets, then you just generate hedging on the other side of that equation, right? So I think you're talking lowest hanging fruit. That's the lowest hanging fruit, right? Is be be accurate and transparent with, hey, this is what my network is. This is where the volatility is. This is where I have the struggles. These are what my volumes are. If I'm thinking, if I'm going to have a new facility come online, I got to be realistic about what those volumes are, right? Because when you put misinformation, out there, and you have dozens, hundreds of providers looking at it, and making their, making their decisions and their pricing decisions, on that. If it doesn't materialize in that manner, you're of course leaving a pretty sour taste in the mouth. So that's from the shipper side, and I think from the carrier side, it's a bit of the same, same type of thing. When you try and game the system and not provide real capacity numbers, try to put in pricing that is, I'll call it a rate of convenience to win the business, just so that you can go and jack it up when it starts coming, like that. That's not a long-term, strategy for success either. It's a short-term strategy for success. I won't, you can win some business on that, but you're not going to keep it for a long period of time. If 2 months in, you're like, oh, well, yeah, I can't live up to that anymore. I'm just going to reject all of this freight, or I'm going to come in for a 20% rate increase, right? If that's the strategy, it's a pretty short-sighted one. So again, it comes back to, working with your partners in a transparent fashion is the low-hanging fruit, I think, for both.
Yeah. And in the former with shippers, is the number one thing the volumes on the lane? Is it the pattern of volumes? Is it weekly volatility or duration of volume or total volume? Is that the number one thing, or does it also go into like wait times at facilities and those other dirty little secrets that you might not want to share in the bid because it's going to give you a higher bid result?
Can I just say yes?
Sure. That's
yes
fine.
to all of those. The biggest one is volume and volatility. Yeah. So, I think that's it. But wait times and difficulty of servicing that lane is, is not a far behind number two. Right. If you're not transparent on those things, then you're just setting yourself up for failure, right? Because the carriers are assuming one thing, the reality is another. And then when the rubber truly meets the road, lots of problems start to pop up.
Is this a temptation for a shipper organization where procurement and logistics is separated, and procurement's running the RFP and then handing that bid result off to logistics, and then maybe logistics takes the blame for the routing guide leakage because of lack of transparency in the bid, but the procurement team gets the pat on the back for getting a good bid result?
I suppose I think it's a temptation all the way around. Like, I don't know if I would necessarily say that temptation is more for, procurement than transportation. I think sometimes a lot of it depends on the pressure that the organization is exerting on those groups in terms of delivering the result. And that's why I'm not to be a shill, but that's why understanding what where the market is and being able to appropriately set expectations as you go into those events becomes important, right? I think the misalignment of expectations is what then causes some of that behavior to creep in, regardless of what part of the organization you're in.
Right.
Yeah. Kevin, one last quick question. Sorry, Dean, I know you want to wrap up maybe here soon. For a small carrier, I know large shippers, want to control their carrier supplier base. For a small shipper that wants to get on board with, a small carrier that wants to get on board with a large shipper, any advice on what you've seen that works for that? Is it picking up the phone and calling monthly to make sure that you're a familiar name to the shipper, or what's the best strategy for a carrier to get in the door as shippers may want to add capacity over the next year or two?
Yeah, one of the things I say, I'll get to the answer, but I want to build it there. One of the things I say to shippers is carrier discovery needs to be an ongoing process, right? You
Hmm.
can't just rely on the bid to find, new capacity. And so flip that to the carriers. It's the same thing, right? It's
Hmm.
really hard as a small new carrier to break into a shipper's network in a bid,
Yeah.
right?
Yeah.
If the shipper doesn't know you,
Right.
or their operations folks don't know you, the likelihood that you're going to win a lot of business
Hmm.
is reduced. Not saying it's impossible by any stretch of the imagination, but it's certainly the odds aren't in your favor, right? So,
Right.
um, so for the same way I say carrier discovery needs to be a ongoing thing. The same thing for carriers, right? They do need to be constantly out there, trying to develop those shipper relationships and try to get in, and trying to get in with a location as a test, right? And then
Hmm.
deliver well, on that test. So it's really important to get some loads under your belt,
Yeah.
with shippers, even if it's a small number of loads, and then of course deliver well on those, right?
Right.
You only get that proverbial first few
Yes.
chances to make a good impression, right? And if you
Yeah.
fail on those first couple of loads,
Mm.
then you're in trouble. So, but you know, I think taking it from a region or a facility standpoint, like there's no point in trying to get into a large national shipper for these cross country lanes or big pieces of their business. You have to
Yeah.
start small and work your way in so that
Mm.
there's some history there and
Hmm.
you are developing a supporter within the operations.
Mm.
Yeah. Yeah. That makes sense.
It's a really good question, Chad. I'm glad we covered that.
Yeah.
That's one of the questions we get from carriers all the time is how do they do that? How do they get more contract freight? I'd not thought through the importance of doing it off bid. That's actually a really good point, Kevin. I'm glad you made
Mhm.
that. Look, we're kind of bumping up on time here. Before I wrap up, Kevin, how can people contact you if they need to get hold of your services?
Easiest way is typically over email, LinkedIn. So just kevin.zweier at argonandco.com, or LinkedIn or out to the website.
Okay.
My ugly mug is out on the website, so you can click on it there.
Yeah. Good stuff. On the Freight Vine podcast, Professor Kaplis is talking to Bobby Holland again. That was out last Thursday. Next week's show, we've got Rick Lagore from Intech Logistics. Very interesting guest talking about the intermodal business and truckload in general. I'll be on with Jimmy Mack on Radio Nemo this Thursday morning, Road Dog Radio Sirius XM at 8 a.m. Don't forget, International Road Check Week is May 13th to 15th this year. Make sure you set up alerts to our live show, subscribe to our channel, and with that, another show is in the books. Thanks for watching. Be safe. Be nice to everyone. We'll see you here next week at 10 a.m. Eastern, 7 a.m. Pacific.